Okay.
All right, well, we are at our monthly budget meeting. And so, Michael, if you'll come up and present to the large crowd that's here.
I have to come all the way from the back so I can make an entrance.
And you're going to have to speak into the microphone.
Okay. All righty. Y'all have your financial packet in front of you that we gave out to you at the last council meeting.
Will you point that more towards, perfect, thank you,
Okay,
sorry.
there we go. The first thing that we're going to look at is our sales and use tax distribution. We can see that it was collected by the merchants in January, remitted to the state in February, and was sent to us in March. The total taxes were $225,595.44. Out of that, the general fund received $131,000. The streets received $33,000, parks received $35,000, and $25,000 went to our bond payment. If you go to the next page, this is our comparison sheet. You'll see that it was $189,975.10. That's 18.77 above what we collected in March of 2022. And it brings us back to almost even. We're 1% above where we were in 2022 as far as collection go for the first 3 months.
So this was actually for the revenues for the month of January, isn't
Yes.
that correct?
Mm-hmm. Yes. The next page is our bar graphs. You can kind of just see the comparison of the year over year, kind of where we're at for 2021, 2022, and 2023. The next sheet is our revenue and expenditure summary report. This is all of our revenue that we've had come in and all the expenses that we've had go out. You can see down through there that we have some of them that are in the red. A lot of that is to do with the fact that you're talking about January, February, March. So we have a lot of front-loaded expenses that come due in January, February, and March. And so the income kind of catches up as we proceed. So far to date, we have revenue of $2.7 million, and we have expenses of just a little over $3 million, and we're running at a deficit of $257,419.47. And one thing to keep in mind when you look at these negative numbers, when you look at our revenue and expenses by department, you'll see that a lot of our departments, we have what's called a beginning fund balance. And if you look over in, just look on, and we have page numbers down at the bottom now, so we're good. We're good. If you go to page 5, and you'll see about 10 of them down, 01004040 beginning fund balance, $400,000, and year-to-date, $0. What that is that's carryover money that we have left over from last year. And we put it in our budget saying that if we need it, we have it there, but we don't transfer it in until we see that we actually need it. So when you see that we're running at a little bit of a deficit, it's because we're paying for everything that we're doing right now, basically pretty much out of the revenue that's coming in at this time. So if we needed to pull any of that reserve money over, or that overflow from last year, then that would wipe out that deficit. So, but we don't like to do that. We like to see if we can get everything paid for by ourselves without having to pull that over.
I was just going to ask you, we got these numbers in the red, so where did that money come from?
That came out of the reserves. Comes out of the reserves.
Okay.
And our goal on that is that we're hoping that the revenues coming in will shrink that number and pay itself back, so we don't have to dip into our reserves. But if we have to, then we do have that extra money out there.
So this line item, tell me again which one that was?
4040 beginning fund balance.
4040.
Yeah.
Okay.
It's almost
So
400 grand.
So you did not pull it out of that?
We have not, for the financial statements, we have not pulled it out of there. We can if we need to, but what we try to do is since a lot of our expenses are front-loaded,
Okay.
we like to let that revenue catch up and pay for those expenses without having to pull it out of our reserves.
I guess I'm just not quite getting it for some reason. But you took it out of reserves to pay it.
Right. We took it out of reserves to pay it. We just don't put it into our accounting until we know that that money is actually going to have to come out of the reserves and it's not going to be replenished by current revenue.
Okay. How long do you give it to do that?
Usually after the mid-year adjustments.
Okay.
Yeah, that usually happens in a few months from now.
Yeah. Because you have so many of your expenses that are front end.
Yes, I understand
Yeah,
that.
that are due
I
in
understand
January
that.
and stuff.
But the money, and that's, well, okay, never mind. Way to go, David.
Really, David, that only happened when you got here.
I know, right? Let me leave again.
Harry, could you put that away from, it's the feedback with the mic and your hearing.
This?
Yes. If you'll put it away from your mic, thanks.
Well, it's usually cell phones that do that.
Okay. Does anybody have any questions about any of the detail on the,
Well, I guess that did bring me to something I had a question about.
okay?
So we've got between, and it may be hard for you to tell me this, and I'm just kind of curious, and it's just more a generality thing, but, you know, at this point of 2021, we were sitting on 8.1 million, and today we're at by this report, it's just a little over 7 million. And this is on page 28
Right.
for anybody else that wants to follow along. So I was
What
just
page are you
curious, you know, just for
Terry, what page are you reading from?
28 by the bottom count.
Okay.
That is going to be in money that we have spent from December of 21. If you'll see, it goes from December of 21 from 8.1 down to December in 2022 to 7.6. So we finished 22 with 7.6. We've hovered there January and February. We dipped a little bit in March. Some of that has to do with the expenses, those expenses that we're talking about, that deficit, because those bills have been paid. So part of that is part of that. It also, one of the things that it has to do is outstanding checks. If we have a lot of outstanding checks, those can cause these numbers at the bank accounts to be a little bit higher because the checks haven't cleared or all the checks hit or something. So it can be a combination of
Yeah.
things.
Well, I mean, that's $1 million difference.
Yes, from 21 to 23, yes.
Right. And so that's pretty significant.
Well, but this is the end of March, and
Well-
that was the year end.
Right, that's right.
So,
But there was $1 million difference at that time.
yeah. Well, going at this rate will be more than end of 2021, wouldn't
Well, we'll see.
Michael?
Well, 2021, we ended with 8.1 million. In December 2022, we ended with 7.6 million. And now in March 31st of 2023, there's a little over $7 million in there.
Yeah.
That's cash within
Yeah.
our account.
Yeah.
Okay.
Okay. The only other thing that I wanted to point out to y'all, and this is just kind of
That's about the same.
cleanup is what this is going to end up being. When you get your report next month, that I'll give you in 2 weeks, if you'll go to page 15.
Mike,
Yes, sir.
back up, no, where Terry's at, he's talking about on page 28. maybe I'm missing something. We're ahead to 8.8183 under 2021. And then 7655 next year. Well, those are the figures adding up from the 6,885, 901, and the 770. Is that correct?
That is, it's going to be a little bit different there. The reason why is because we consolidated some accounts and moved them into other accounts. So
But I mean, should that bottom figure add up to the,
those two, the 6.85 and the 770 should equal that bottom number. I'm going to have to go back and put those accounts that we took out of there, because this spreadsheet is actually...
The one right before that, the 5619, doesn't add up to the 81.
Right. This spreadsheet is actually three sets. You have the top, which is our current accounts, you have the CDs, and then there's another piece to it, that's the accounts that we have closed or have moved the money to a different account. So I'll start adding that on there so that you can see that they all add up.
But what we're showing on this, on this chart, or whatever you call it, this sheet, is that for the year ending December 2022, we were down $500,000. And then between that and December of 2023, we were down another $500,000.
But we're not done yet.
No, between the end of 2022 and today, we're down another $500,000, 3 months.
Well, and a lot of that is going to be capital expenditures. You've got the Public Works building in there, which is $800,000. You've
Right.
got the auditorium in there, which is $300,000.
All out of pocket.
Yep.
Yeah.
So that's
that-
what's going to...
That's what
And,
makes it up.
And CAPC is going to be replenishing that money to
That
give back that
$300,000,
money,
yeah.
so it's a wash.
Yeah.
So back to page 15, what I just kind of want to give you a heads up here so that when you see this next month, you'll kind of know what's going on. This is our debt service section of it. It's Fund 40. This is going to look a little bit different when you get it next month, just because the auditors have requested that we start recording some things differently, recording some things in here. So I'll explain all that to you. It'll be easier to explain next month or next time when we actually have figures in here. But
That's for this page 30.
yeah, or page 15, yeah.
Oh,
So
page
if you-
15.
Yeah, so if
Oh,
you
okay.
look at that next week and you like,
Okay.
wow, what's happened, I'll explain all that at our next
good.
one.
Thank you.
If you go to page 25, you're going to see basically kind of what we're talking about there as far as our revenue in March versus our expenses in March. They exceeded our revenue, so that's what helped cause